Okay, go on.
I was like, we're going into interest rates.
Let's finish into interest rates and give everybody some actions.
Yeah, so interest rates, how much higher could they go? And what can an income investor do? What can they be doing now?
Yeah, this is real key.
I got some good questions around this.
Yeah, let's go to the charts, and then we'll wrap it up for everybody. So this is the chart we shared in June. We were basically at that moment, we have this channel. We've said for years, interest rates trade in channels. Then they'll break out of those channels when there's a major shift, fundamental shift happening. And obviously there's a major fundamental shift happening in the world. So we broke out of that channel. Our attitude then was, we'll probably one of two things. We'll either slow down here and maybe snap back down into the twos if people got worried about recession. Or if that doesn't happen, you're going to 4%, just like as a round number target. And since June, yes, there's been a little, is there going to be? Yes, we have 2 GDP numbers negative, but it's not a real recession because employment's so good. So there's been this wishy-washiness on recession. So there's been no need to snap back. There was no pivot from the Fed. So no need. So now it's gravitating higher towards that round number of 4, right? So let's go to the next slide. Similar to the dollar, my attitude's changed here because if we would have kind of stalled at the red line and come back into the channel and played around in there, then I would have thought to myself, okay, interest rates are probably going to stay between 2 and 3% for the foreseeable future until we find out what's going on in the economy. Is it slowing down or not? But the fact that it's robustly broken out makes me feel like now, and you can start to go through some of this now, we're getting into a situation that the wave count and the move in the dollar in interest rates is bigger, just like in the dollar, because they're correlated, is bigger than maybe thought. And so now what it does, if you keep going, it'll give you kind of, I think what we're going to see here is a new range starting to get formed. Like we're in this last move higher in the dollar before it, kind of peters out and takes a breather. And then, but I think after that, the new range in interest rates is going to be like, between 3 and 4, maybe 2.8 to 4.25, right? If that happens, that means mortgage rates, you should expect mortgage rates to be staying between let's say 5 and 6.5, right? If you can keep mortgage rates at 5 to 6.5 for like a year and a half, people will adjust to that.
Yep.
Prices will probably come down, but prices won't have to come down that much, right? Think about it. We're already there. And we already know that for every $100,000 you borrow, this kind of move equals X number of dollars each month, right? So prices will eventually adjust for that in the areas that affordability needs to adjust. So I think the trick for the Fed is just get stability here. If they can just get it between 3 and 5, stay stable. Right now, we just don't know where it's going to settle. So from an investment thesis, if you go to the next, go ahead.
Before we go on, because one of the things we talked about the other day was, our thought process has changed, and I more and more am starting to agree with you because the days of cheap money are gone.
Yeah. Yep.
The days of low cost of employment is gone. The days of cheap inputs for production are gone. So there's no way that we can get low interest rates anymore because we have high inflation, we have high costs of goods, all this type of stuff that's going to be around for the foreseeable future. So the days of lower interest rates I don't think are going to happen as much. Typically, Fed has reversed and lowered their, Fed funds rate. I don't think they're going to be able to do that going forward.
I think they do it if there's defaults that are systemic, like always.
But I don't know if it has
if there
an
becomes
effect.
a systemic issue, then you'll see them. But until that systemic issue arises, you're probably right. And you should never build your investment portfolio or your investment thesis around systemic. It'd be you should never build your investment thesis around things that happen once every 30 years. Yeah. Right. You build your investment thesis around what happens every 3 out of 5 days.
Right.
So let's what do we got next? And it's. So, if I was retired, or if I was somebody who was saying, how do I, with interest rates rising, stock market falling, if I'm in cash, how do I create income? If I'm changing my portfolio around and I still need income, what do I do, right? Well, then you go for those dividend-paying stocks that we identified in those relatively stronger categories. If we're right on some of these secular trends in energy and utilities and things like that, that's very helpful. And I do think that's part of the Fed's understanding of things is that if you are going to take away from the baby boomers' net worth a little bit, at least make the income thing providers a little bit more palatable for them. So I would stick in those. I would be looking in those sectors, and this is only for somebody who's like, I got to be an equity holder, right? Mm-hmm. If you like, just this is the only way you do things. Just remember, we're in a generational bear market, so keep a lot of cash, and keep your mind on recovery because I think even these particular sectors, relative strength means that they're stronger than the others, and that can mean that the worst sector goes down 30%, and the best of the worst downside is down 10. So that would be the one down 10 is relative strength better than the 30, but you're still down, right? So when you're in a market, when the tide's lowering, even the stronger relative strength sectors are working against the wind. So if you're going to be in equities, play small until we get through this bear market. In the fixed income world, patience will pay because you really don't want to be making a lot of moves in the face of interest rates blasting higher. So you want to see a little bit of a reprieve and see where this new range becomes. And that's going to be 6-8 months before we really know it for sure. We're going to speculate and guess around it, but we won't know for sure until it's hindsight.
Well, one nice thing about the 2-year having a pretty decent yield is that at least you can hold and get a 4% and hold it for 2 years and don't have to worry about that volatility in the interest rates.
I thought I'd never hear people call me up and go, wow, man, I'm going to get 3%. I remember when rates dropped to 5 and people were like, I'm taking my money out of the bank. 5% is not enough. This was like, late 90s. And like now it gets to 3 and people are like, holy cow, 3, wow, give them all my money.
Right. I've seen a few bank savings accounts at 1.5–2% now.
Yeah, well, I mean, that's why they do it.
Yield,
yeah. Now, realize what happens there. This is how the banking system works if you want some insight. So what's going to happen now is people who have their money in like a CD, that's in the banking system. And then what will happen is they'll log on and Chase will send them a little message of, hey, we have a high yielding money market account that is like a point higher than the CD. That actually creates more dollar strength because what ends up happening is when you move from being in a CD to that money market's backed by treasuries and other things. So now it's out of the banking system technically, right? So it's an interesting thing that feeds upon itself with and this is why they raise rates is it takes money out of the system, out of the banking system, and then when the bank has less money, they can't loan as much, right? Yep. But it's still more profitable for the bank because they're offering a product that has a bigger spread, right? So they make the money on the back end. It's an interesting business. So when the time's right, same thing. The pattern will be like we talked before: mortgage-backed bonds, corporate bonds, equities, boom, boom, boom. When the time is right,
this is important. Yeah.
Build a bond ladder. Yeah. Don't buy a bond fund. I mean, don't be lazy. And don't work with somebody who's lazy. If you sit down with a financial guy and you say, hey, I want fixed income, and they come back to you with 10 mutual funds that are bond funds, just leave. I mean, that's not.
Why are you paying them for that?
He didn't work, folks. Exactly. There was no work done there. I mean, okay, sure, he Googled, right? But if you want somebody to earn their money and actually work for you, build a bond ladder. Do it right. Cut out all the middleman. Build a nice bond ladder. Get the bonds at a discount. So then that way you get income and growth. And then that way at least you get what you paid for. And you're not victim to the broader, whims of the market. You can build a bond ladder very concentrated in ways to manage risk.
And for those that may not know what a bond ladder is, you're basically laddering out all of this. So if you choose a 10-year period, you're going to have a 1-year bond, a 2-year bond, a 5-year bond, 6, 7, 8 years, all the way up to 10 years. And each one's going to mature over a certain period of time, and then you kind of just continue to cycle that ladder.
That was a good explanation.
Yeah.
Oh, nice.
So
climb the ladder. So what else do we have there?
Know your alternatives. Here you go, Patrick.
Yeah. I
go.
mean, hey, listen, if you're a fixed income person, this is where knowing alternatives are. And